is Abigail Noble. I work at the World Economic Forum and I lead the impact investing work. So at the World Economic Forum, we bring together businesses, governments, and civil society and try to think about the most pressing problems that the world faces and how we can use innovative solutions to tackle them. So with impact investing, we realize that governments are trying to deliver social services and do it in a more cost-efficient way. Investors are looking for untapped opportunities where they're both getting financial return and hopefully doing something good for the world. And civil society, social entrepreneurs, millennials are very much interested in what the world is going to look like in the future and how we can use innovative solutions to extend access to opportunities. With the Mainstreaming Impact Investing Initiative, we're looking at the challenges and the constraints that mainstream investors such as pension funds, venture capital, private equity face in getting engaged in impact investing, and how we can unlock some of those constraints, how we can get around some of those barriers that they face, whether it's the deal size. The average private equity deal is about $36 million. The average impact private equity deal is about $2 million. So for private equity funds to get engaged in impact investing, it's going to cost more because it's double bottom line to do the due diligence. The size of the deal is much smaller, so they need to think about the fee structure. And how can we come up with innovative solutions, whether it's pooling the capital, whether it's thinking about a different approach to due diligence or crowdsourcing some of the data. So we're looking at lots of different opportunities. And some of the things that we're hearing as well as pension funds are more interested in ESG criteria, which is putting pressure on the private equity funds to look at more impact deals. University endowments and sovereign wealth funds are also starting to look at the impact investing space. So things are moving in the institutional capital side, and funds are interested in how they can get up to speed on making impact investments. Very good question. Well, one thing to keep in mind is that there's a range of returns. When we talk about patient capital, Acumen Fund is very cautious about saying we're taking the long view, the long run, and some investments only make a 0 to 1% return. If you look at impact private equity funds like Leapfrog, they're making in the 20 and up percentile of returns. And what's really important to keep in mind is what are the different stakeholders that the impact investors have and that mainstream investors have. So pension funds are thinking about when people retire in 40, 50 years, they want to make sure that those retirees can have a stable income, and they've got a fiduciary responsibility for that. And that makes sense for those investors and just for making the world a better place. Depending on the sector, depending on the geography, microfinance traditionally gets higher returns than investments in things like education and sometimes healthcare. So the investor needs to think about what are their priorities in terms of social impact and legacy, what are their liquidity needs, is it something where they need to be able to cash out in the short term, or they can take a longer view and perspective and range. And who are they accountable to? Sometimes if it's one family office or high net worth individual, they're willing to take a lower return. Sometimes if it's a pension fund or a university endowment, they do need to get high single digit or double digit returns. One of the things that I find most encouraging is we looked at the GIN impact base survey data and found that over 70% of impact investment funds surveyed target 11% rate of return or higher. And that's targeted, it's not actual. It's going to take a few years for us to see enough exits to know what the actual returns are. But then if you compare that to what state and municipal pension funds across the US are looking for, somewhere in the order of 7.5 to 8.5% returns. So even if these impact investment funds get a few points return lower than what they target, it's still within the range of what pension funds are looking for. So I think it is feasible to get institutional investors interested in impact investment deals based purely on the returns or the expected returns. Some of the challenges, though, that we are dealing with are deal size and the cost of doing due diligence and knowing what a successful exit looks like in terms of social return and financial return, because there are very few deals and successful exits of double bottom line companies. So in short, I think it's a meaningful conversation to talk about what are realistic returns or what's possible, but there's a lot more nuance there in terms of why certain investors have such high need to target for such high returns or demand such high returns, and also knowing that different sectors in different geographies will get different returns. Some will be more in the average of 2 to 5%, others will be more in the 12% range, and then a few, can have wildly successful returns in 20% and higher. So it depends on the investor and it depends on the need. It is a risk. There could be a positive selection bias where the impact investment deals that target and expect to have the highest returns will get the most capital and the most investors, and those that are targeting for lower returns might not be able to get as much commercial capital. But I think that's the importance of philanthropic capital and development finance institutions. And there's been a lot of work that's been developed now around layered capital funds. So Rockefeller Foundation and OPIC are looking at how do you create a layered fund, and you have development finance coming in and foundations coming in and commercial capital. The UK government has created one commingling fund and is exploring creating additional ones where you understand that commercial investors need a higher return and usually in a shorter term time horizon. Development finance institutions might be able to take a longer term view and think about building the sector, and foundations and philanthropic individuals might prioritize a certain social impact or theory of change, or are willing to take a lower return but just want that impact, that result to come out. So if you think about those kinds of structures, and if you think about how there are some needs that might not be able to attract commercial investment, they're going to need to go to foundations to get grants, low interest or subsidized loans. I think we can build the space and create the world that we want and need. So in terms of building the impact investing space and sector and advancing it, I think it's really important for us to tackle this mindset of trade-off, and that whenever you target a social impact or social return, there's necessarily going to be a lower financial return. I think that's the case in some situations, and that's why philanthropic capital and development finance capital is very important. But it's not the case for all situations. And I think when we start to realize and think about how targeting social and environmental impact and returns can actually boost or make a more long-run stable financial return, then we start to have a more meaningful conversation. And this was actually what the conversations at Davos revolved around this past January. We looked at what are some environmental shocks, such as climate change, or when you look at things like the Arab Spring and social unrest related to youth unemployment or lack of opportunities or lack of social inclusion, how that can affect financial markets. And when you do have more stable political and social situations, it's a better business climate, and therefore you have more stable long-run financial returns. So impact investing is a very real way to create a more stable and inclusive market economy. And once we start to adapt that mindset, we can see how you can target both social and financial returns and over the long run create the world that we want to see. The other thing is looking at government policy. I think the UK has been charging ahead with some policies that are quite innovative, thinking about tax incentives and looking at unclaimed bank assets and creating big society capital. Around the world, there are small innovations that are happening in Latin America and Africa and the United States. In the US, we have pay for success bonds, and Treasury Department just allocated $300 million for that. And there are discussions around tax policy in the United States. I think over the next few years, we'll see whether the space develops further. And if it does, it could unlock and harness the power of private capital in impact investing, as well as create more inclusive societies. So the numbers that we've heard is that over the next 4 decades, the millennial generation is set to inherit $41 trillion from the baby boomer generation. For me, what that means is that a lot more investment decisions and business decisions will include a social or environmental component. A lot more companies that receive investment capital will be fair trade companies, or will be ones that are environmentally sustainable. There's going to be a lot more appetite for LEED certified buildings, because that's where people will want to live. So I think we will see, not only from a kind of marketing and branding perspective, but just that it makes sense from a strategy perspective. You can reach more customers. There's going to be a lot more loyalty when you have a strong social mission, when a company has a strong social mission. And it will replace goodwill. If your company, if your business cares about the community, incorporates the highest standards of environmental stewardship, of ethical practices within the business, and of thinking about how it's a good corporate global citizen, the company is more likely to last over the medium to long term, and to have more stability if it's a publicly traded company in the markets, and attract the best employees and continue to grow. So I think it will create a virtuous cycle of businesses that do well and do good.